So you've been wanting to research companies, but you don't necessarily have the time to do it yourself, or you don't know how to do it yourself. In this series of videos, I'm going to be going step by step through my entire process from beginning to end on how I find companies, what I look for when I do my initial research on the companies. If they pass my initial research, how do I value and evaluate them after reading their financial statements? I will go step by step, including valuations when we get to that point, in how to evaluate companies. My name is Jason Rivera, and welcome to Value Investing Journey Case Studies. Hey, Jason here. Now that I am looking at companies again, I've started to get requests from people to look at companies that they're interested or they just want to know more about. Last video, I evaluated AMNF stock ticker AMNF, Armanino Foods Company for Keith L. In this video, I am evaluating Bed Bath & Beyond, stock ticker BBBY for Tomaz. Tomaz P. Let's get to it. Okay, $2.5 billion company. Billion. Okay, so 3.3. Two. .9%, 5-year average. Okay, share count has fallen drastically since 2010, which is past like 260 million. 260 million, 2010 to 140 million. .2%. 46.2. Which, of course, because they're apparently doing a good job on buying back their shares, how can I tell that? Because in that same time period, their book value per share has risen significantly. We will get to if this is a real and legitimate number, or if it's full of things like goodwill and intangible assets shortly. But at least at this level, that's fantastic. So 12.93. $37, no, not 37%. $159. Okay, that makes more sense. 59%. 0.2%. Okay, ROIC 9.9. Oops. $18.4%. Margins have fallen significantly, both ROIC and OM over time. Plus 26, 31.7, plus 28.7, plus 25.4. So what I can tell you here, 15.2, 25.4. This company has a significant debt load. Why? This number is higher than this number, and this number is higher than this number. When ROE is higher than ROIC, it means the company has debt, and in this case, they have a significant debt load, it looks like. We'll get back to that shortly. And actually, as a percentage, over time, this has gotten smaller. In 2015, something happened, and they looked like they had to take out a bunch of debt because they were about even until here. So in 2015, they had to take out a significant amount of debt. 2016, 2017, they were still dealing with a significant debt load, and that's actually gotten smaller. It was about 11 percentage points in 2016, and now it's about almost 5.3 or something like that, off the top of my head, percentage points. So it's fallen significantly since then. So free cash flow to sales, 3.9. So 6.3% on average. Again, this has fallen. All their margins, all their important margins have fallen over time, which is to be expected with a retail company. I'll get to that, my thoughts on that shortly as well, because I can almost guarantee its CCC has risen over time. Before we get to that, cash as a percentage of balance sheet, about 10.3%. Short-term debt, none. Long-term debt as a percentage of balance sheet, 21%. Not great. Inventory is the biggest balance sheet item. Okay. And of course, they don't report this number, which is all important for a retail company. So that's a gigantic, massive red flag right here if they don't report this number, because they don't report this number. Gigantic, massive red flag. So we can kind of tell, before I do that, okay, let's get back to cash conversion cycle. Actually, let's go to the EV first. So 2, 4, balance sheet. Back up. Minus 724. Okay, I'm getting sidetracked because I'm seeing some other problematic numbers, but we'll get back to those. So plus 1492. It doesn't look like this company has any minority interest or preferred stock. So let us get to the EV is $3.265 billion. 3265. 3265. Plus 135 plus 1415 plus 1554 equals 4865. So what that means is that makes 0 sense. I've never seen that before. So that's interesting. 4865. 4865. Very interesting. I've never seen that before. We'll get back to that in a second. Explain what that means. Cash flow. Oops. There we go. Four plus 8, 684 plus 855, 2691. Very interesting. So I've never seen this before, ever, that this number is higher than this number after evaluating thousands of companies all over the world on every continent except Antarctica. I've never seen this number from either of these cases be higher than this number, ever, not once. So what that means is this number is going to be below 0, meaning the company is massively overvalued or undervalued on a relative basis. Divide by 4865. 67. Essentially, that means, according to its profitability, 67.1%. Again, so 0.7. I'll round up because I never put this in percentages because, frankly, again, I've never seen this. So let me keep doing this and I'll explain what my thought process was there. Divided by 2691. 1.21. So what these mean, typically I look for anything under 8. The lowest numbers I've seen before this were, I think, 3 right here and 2 right here. So these are by far the lowest relative valuations I've seen here, which leads to gigantic earnings yield. 4865 divided by 3265. So again, I've never seen this number above, I think, 30 or 40%, and it's 1.49, 149%. 3265, 82%. So, according to these numbers, you should expect to earn these amounts owning this company within the next year. However, as deep value investors, actually, let me see if I see anything weird on here. Nothing that's catching my eye. As deep value investors, we focus on balance sheet strength first. So, right here is a gigantic problem number. Fixtures and equipment. Why this company is not as undervalued as it looks is found in this number and this number right here. Inventories and fixtures and equipment. Retail is getting destroyed by Amazon, just absolutely annihilated, which is why this company's margins have fallen off a cliff, in some cases about by 50% in the last 5 years. People don't shop at retail anymore for the most part. If they can, they buy it off Amazon, at least in the US. People don't like going to these kind of stores anymore, Bed Bath & Beyond, Sears, JCPenney's, Toys R Us, these kind of stores anymore. These are all pretty much going to go out of business at some point, in my opinion. And to illustrate this point, actually, before I get to that, so total assets, what is this? So it's actually selling below its net asset value, 41 minus 4152. So its net asset value is $2.9 billion. Its market cap was 2.5. So essentially what that means is people think this company is going to go out of business. So this book value right here, what I was talking about up here, isn't really legitimate. This number right here and this number right here will be completely destroyed in the event of a bankruptcy, which is likely to happen at some point for Bed Bath & Beyond because of what's happening in the greater Amazon and retail arenas. If I were to do a reproduction valuation of this company, I would discount this. I would only take 40% of this value, so I discount 60% of this value. And I would, this just follows in the property, plant, and equipment. So actually, after depreciation, let's see, I would discount this number almost completely, because if you're in an asset reproduction valuation, if you're to that point, you're pretty much having to auction off your stuff. This number's risen significantly. Why? $1 billion in 5 years. That's insane. So I would discount this number almost completely. This is interesting. This is interesting. And this number I would get rid of. This is the net number here. I would discount this number almost 100%, because net of depreciation and this, and I guess just this, because this is already, so most of their property, plant, and equipment value is coming from this, their net property, plant, and equipment value, which is almost worthless in a reproduction value situation. So I would discount this number almost 100% in an asset reproduction valuation, which would essentially, just doing those two, it would wipe off $2.5 billion to $3 billion worth of value on this company's balance sheet, which would actually leave them a negative equity value, which is essentially the case we're in right now. So 741 minus what was it, 270. 2,500. So actually, that would leave them only with a positive net asset value of about 400 million at the 2.5 billion rate, and it would be negative like 100 million in the 3 billion case that I was talking about. So I frankly don't believe this company's numbers right here, to be truthful. Again, why? Because of the coming or the beginning retail apocalypse, where companies in the retail arena are just going out of business right and left because they can't compete with Amazon. Toys R Us, Sears, JCPenney's, Kmart, KB Toys years ago. What else? There are a ton of them that have already gone out of business, and I think pretty much all these kind of stores, Bed Bath & Beyond being one of them, are going to go out of business at some point. So again, frankly, I do not believe this valuation, the valuation that we talked about here, because their balance sheet strength certainly isn't as strong as it looks. And essentially, the company is being priced as if it's going out of business. That's why these returns are so high right here. And that's why it's net asset value as things currently stand is so high. It's higher than its current market cap because the market doesn't believe these numbers to be true as well. So another issue is where, oh, that's what I was going to show you. Okay, so inventories, they don't even measure accounts receivable on here, which is not good. That's odd for a retail company. I can't say I've ever seen that again either. So that's not good, because usually what I would do is I would measure to see if inventories and accounts receivable are rising at about the same time. Can't do that here, which is again why the cash conversion cycle is not there. So that's not good. Another red flag, this number right here. For retail companies, the CCC is ultra important. It's probably the most important number. So that they don't report this, they don't report accounts receivable, that's a gigantic, massive red flag to me. Again, if I don't trust what management is doing, even though the undervaluation looks significant, I do not invest in the situation. I do not trust that the management is doing a great job here, because I know they're not doing a great job, because eventually Bed Bath & Beyond is highly likely to go out of business, which is why the market is pricing it as if it's going out of business. So along with that, they don't report their accounts receivable to Morningstar, which means they don't report their cash conversion cycle, which again is probably the most important single number for a retailer. Frankly, it's insane that they don't report that number. That's how important the number is for retailers. So what I can show you is, again, they don't report the accounts receivable for the last 10 years, actually, which is insane. So this right here is a massive decline in shareholders' equity in 10 years. Massive, almost 30 percentage points as a percentage of the balance sheet. So there are multiple red flags here. Again, number one rule for me is I have to be able to trust management and trust that they are doing a good job and that they're going to continue doing a good job. Even though I've never seen this massive of an undervaluation ever, not once in thousands of companies evaluated, I do not trust that management is doing a good job here. Their margins have sometimes been halved in the last 5 years. Right there. Right there. They do not report numbers. They're being priced as if they're going out of business. Amazon is killing all these businesses, which frankly, I mean, they're not efficient. They're not doing a good job. So in my opinion, it's not necessarily a bad thing. It sucks for the people who work at these places, and I just actually read an article about this in the, I think it was the Tampa Bay Times, the local newspaper where I'm at, is that Kmart was closing around here, and I think there's only one Kmart left, and it's closing around here. and it was talking about these people losing their jobs and stuff and how they're getting severances, and which is good that they're getting severances. But my mom told me about that. And I was like, they should have known that this has been coming for years, and the people who work at Bed Bath & Beyond should know the same thing. It's coming. At some point, the market is already pricing your company as if it's going out of business. So unless the company does something drastic, it's going to go out of business. That's why these numbers are so high. That's why these numbers are so low, and that's why this company is being priced as if it's going out of business. Again, rule number one for me: can't trust management. I don't invest in the situation. Doesn't matter if it's a 10x, a 1x, a 100x. Doesn't matter. If I don't trust managers, I don't invest in the situation. So I don't trust management and the business model and the industry in this. So there's no way, especially with the falling margins and everything. I don't care what the undervaluation is. I wouldn't invest in this company. Because again, frankly, I think it's going to go out of business sooner rather than later. So in that case, owning the debt might be interesting. Owning the equity would pretty much be a disaster. In debt, in bankruptcy filings, equity shareholders almost always get nothing. Debt shareholders get whatever they can get, and then whatever is left, the equity shareholders get, if there's anything left, which in this case I highly doubt there is, because again, I showed you can easily erase $2.5 to $3 billion worth of value on their balance sheet. So again, I hope you enjoyed this. Thanks for the recommendation, Tomaz P. And if you have a company you want me to evaluate, let me know. If you like this evaluation, let me know in the comments below. If I missed something, let me know in the comments below. And I will talk to you in the